What is the difference between the cash value and the income base for a fixed index annuity with an income rider? Let's find out. This right here is the cash value. This is where your money grows that you put into the account. And if you wanted to get some out of it, you could. Now, if you took money out of the cash value, it would reduce your monthly income. The cash value, it does have an effect on the death benefit. And if you just wanted to get some extra money out of your account, that's not related to your income amount. Now, this one is actually the income base. And the income base is simply a paycheck machine. Its job is to calculate your monthly guaranteed retirement paycheck. It's called the phantom account sometimes because you can't go in and just take some money out if you needed to. While this number does grow, it's not really money. Only can use this account to get a paycheck for life. If you need to get a new car or something like that, you couldn't come into this and get that money out. I'm going to do an example that'll help paint a picture of how this thing really works. So we have a male who is 60 years old. He has $500,000 and he puts it into the Athene fixed index annuity with an income rider. And this is how it works. Right now, we're going to talk about the income base. See right there's the little symbol so you'll know where we are. He puts $500,000 into this Athene annuity when he's 60 years old. When he is 62, he decided that he wanted to turn on his income. And so when he is 62, he can get out $42,000 a year, which is $3,500 a month. So how does that income base grow? Well, I'll tell you. But when I tell you the interest rate, I want you to promise me that you're going to forget it. I'll explain why. This income base has a roll-up rate. And the roll-up rate is the interest rate that his money starts growing at, and it doesn't stop until he turns on the income. As long as he puts his money in before he turns on the income, he's going to make 10% on that income base. You can see right here, he put in $500,000. That made 10%, which is $50,000. It jumped up to $550,000 the next year. Then it made 10% again. So the next year's at $600,000. That's how it makes that roll-up rate. And then it stops earning that once you turn on the income. He's 62. The way we know the amount of money he gets is that Athene says that a 62-year-old, they'll have a 7% payout when they turn 62. And what that means is you multiply 7% times $600,000, and that gets you $42,000. So that's how much money he'll get every year until he dies. Now, what if he had decided, I think I want to wait till I'm 66 to turn on the income? He certainly could have done that, and he would have gotten $57,600 every year. I have a video that I'll link in the description that explains a long-term care enhancement that some annuities have. Athene does have that on their annuities. And what that means is if after you've turned on your income, you have a long-term care event, meaning if you had to go into a nursing home for 180 consecutive days, Athene says they'll give you double income for a year, which is $84,000 for up to 5 years or until the policy goes to zero, at which time you would go back to getting the $42,000. And some annuity carriers offer it and just some don't. But once the policy goes to zero, the cash value goes to zero, not this, but the cash value, then you go back to getting that. Now, we're going to talk about the cash value. The cash value, you see right here, this is how this part of it works. A 60-year-old, again, put in $500,000, the same person we're talking about, and he is going to get a return, not very great, of 3.8%. It's not going to be that great. It might be less, it might be a little more. And you just don't want to have your hopes up on this part of it because, again, the reason that we're buying this, the reason you're putting your money in this is not because of that at all. You're putting your money in so you'll be able to get a paycheck for life. And if something were to happen to you like early, yes, you want that money to go to Beneficiary. So I'll explain how that works. But that is not a very good earnings because that's not the point of it. The point of this is this other page. This page is the income base. And this is the most important page because it tells you exactly what you're going to get every single year until you die. Now, this other page, the cash value, it's important, but it's not as important as the income base. You're going to put your money in, it's going to grow, you're going to decide when to turn it on, and then you're going to turn it on, and you're going to rely on that money coming every single month. If you look at the cash value here, put your money in, and it grows at 3.8%. There is a 1% rider fee on this, and what that means, the rider fee pays for your guaranteed paycheck for life. So the insurance company says if you'll pay 1% a year, that guarantees your lifelong income. So this guy who opens this in 2 years, he'll get $42,000 until he dies, even if he lives to be 110 years old. He's 60 years old. He puts in $500,000. When he's 62, he starts to receive $42,000 a year. That first year, he receives $42,000. The next year, 42 plus 42 is 84, right? So that adds up. It's cumulative. Then the next year, add $42,000 to that. Now it's up to 126. So he's taken out $126,000. What if he were to pass away when he is 68? Let's look at that. And the way these death benefits work is whatever you put in to this account plus what that cash value earns, not the 10%, but this one, the cash value, what that cash value earns minus any withdrawals is how much will go to your beneficiary. So it's very fair. Let's say that he lives to be 68 years old, passes away when he's 68. When he's 68, he will have already taken out $294,000. But then you come over here and you see his beneficiary will still get $305,000. And then if he were to live to 74, he passed away then, he will have taken out $546,000, and then his beneficiary would get $81,000 about. It's a fair trade. Why is this annuity called a cent pro 10? And can you take out your cash value? Your cash value is right there. So can I get it out? When you're working somewhere, you've worked there 40 years, you know you're going to get a pension, right? You're not going to ever say, I don't want that pension. Just forget it. I don't want it. I don't care. I'm going to, do something else. You would never, ever do that because you know that pension is going to pay you until you die. That's the way you need to think about this. You put your money in, you're going to wait for that money, and then that income is going to start. You could, if you had to, get money out of your cash value. It's right there, right? You could get it out, but you don't want to do that. Why? Well, because it'll reduce your monthly amount. Why would you do that? I'm going to explain how it works just so it can build your confidence and so you'll just kind of know the mechanics of it so your money's not just going out in the wild blue yonder. If you look over here, again, I said it's a Pro 10. Athene has a 5-year, a 7-year, and a 10-year. This is the 10-year. The 10-year is going to pay you more income than the 5 or 7 year. So when you put your money in, we already know we're doing this for life, right? Why is that? Well, because we're going to need a paycheck for life. So we know this is going to be a lifelong thing. Athene has agreed to guarantee they will pay you every year until you die. Whenever you put your $500,000 into Athene and you say you're going to keep it in there for at least 10 years, even though you and I both know you're keeping it in there forever because you're going to get a paycheck for life. Okay. But you put your money in and then Athene invests that money for their finances. And so they're counting on that. So then if you were to come back and say, yeah, I'm going to cash it out. If you decided to do that, Athene would have to go out into the bond market or however they're investing their money, and they would probably have to pay a penalty. So they're going to penalize you. So if you take money out of this in the first 10 years, you would have a penalty. It would be a surrender penalty, and that's the 10-year thing. I've been helping people with these for years, and I've never had someone say, yeah, I want to cancel that. I don't want to do that because they know they're going to get that money coming in every month until they die. Now, you are actually able to get 10% out a year without a penalty. Don't forget, if you take it out, it's going to reduce your monthly income. But you are allowed to do that without a penalty. After the 10 years, you won't have a penalty. You can get out whatever the value is of it at that time. But you're probably not going to do that because you're going to get the income for life. Now, let's say you open it when he's 60 and when he's 67, you look over here and the actual value of the policy is $339,000, but the cash value is $329,000. So that takes that surrender percentage into account. After 10 years, you can see that these are the same. Now, can you go in this cash value and just get out $20,000 to buy a car? Yeah, you could after 10 years without a penalty, but you don't want to do that. We don't ever want to do that because it would reduce your monthly amount. There's two different kinds of annuities. There's one where you put your money in, it annuitizes it, and you get paychecks for life. Or there's an income rider one like this one, and you still are going to get paychecks for life. The difference is that you don't have to forego all of your $500,000 with this kind. It's not something to really get excited about because, again, you're doing this for a paycheck for life. But still, even if you had to come in and get it, if you had to get some out, you could. You would lose the income, but this is available for you to use and to get it out if you needed to. Most annuities are thought of as the other type where you put your money in, it freezes it, and it spits out paychecks for life. This is not that kind. It's more flexible. But again, we want to always still focus on that paycheck for life because that's what we're doing this for. We're not doing it for the return on the cash value. We're doing it because we see the value of having a paycheck coming in for life. Now, you can see over here that he started getting $42,000 and you can see it never stopped. Then I'll go to the next page as well. Even when the cash value goes to zero right here, he's still going to get this paycheck every year until he dies. And if you look right here, if he lived to be 85, he will have taken out $1 million. So that's a lot of money. So he's taking out that money. But the way that you can value this, the value of it is the peace of mind you get knowing you have a paycheck coming to your account. The main difference between the income base and the cash value, the cash value, you can get your money out if you needed to, and it's there for you. It's not going to make a lot of money. It does affect your beneficiary. And then the income base, that is your paycheck machine. That is going to give a paycheck for life, and it's not going to ever stop. And it's going to have that 10% interest rate that I told you to forget about, because that's the roll-up rate. And it's going to grow a lot on the income side, but you can't ever just take a chunk out of that. Now, there are some advisors out there who really don't look out for people's best interests, and they'll say, oh, guess what the rate is? You're getting 10%, or sometimes there'll be a bonus where you'll get a 20% bonus to sign on, and it really doesn't matter. What matters is this amount that you're going to be getting every month until you die. That is really the only thing that matters. You want to make sure that check is coming for life, because that's what you need. Now, again, it's called the phantom account because it's almost like a fake account. Not really. It calculates your paycheck. So that's that first important page that I showed you right here. The most important part of the whole annuity is this page. It tells you how much you're going to get. It tells you how much it's going to grow, and then you're going to get that amount for life, and it's never going to go down. All right, y'all, hope this helps. If you need help doing everything we've discussed in the video, watch this no-cost training on building income that lasts throughout retirement. From there, if you want to see what this strategy looks like for you personally, you'll be directed to my calendar, where you can schedule a free income planning session where I will create a personalized retirement income report just for you.